G'day folks, welcome back to another update for gold and silver. Now they're consolidating, but there's also a downside risk with the CCI moving further south. Before you go any further, make sure you hit that like and subscribe button to support the channel and reference the +1 videos for a deeper dive into some of the trading strategies we use. Now a lot of people do use fundamentals, and I do include it for those that are interested. I use fundamentals more as a long-term prospect. I don't trade on them. So just be very careful about trading. That's okay. So having said that, I don't trade on fundamentals alone. It's primarily technicals, as you know. So both gold and silver are benefiting from dual theme of safe haven demand, driven by geopolitics, trade risks, policy uncertainty, and real economy drivers, inflation concerns, central bank accumulation. Gold is firmly in its safe haven mode, strong central buying, weaker US dollar, stagflation fears and geopolitical flashpoints underpin the rally. While near-term corrections may happen, the medium-term view is very bullish, especially if global uncertainty escalates. Silver carries added industrial demand upside, renewables, electronics, which gives it a different growth vector compared to gold. However, its vulnerability to a slowdown in industrial activity or easing of safe haven flows means caution is warranted. On the geopolitical front, risks such as major conflict, trade war escalation, reserve currency shifts, or central bank policy shocks could serve as triggers for further upside in both metals, particularly gold. If those risks fade, there is a risk of consolidation or pullback, especially in silver. Okay, so we predominantly trade on technicals, and here we've got the weekly with the moving averages and the price above the moving averages. Now notice the CCI is broken into that moving average range. This is for gold. So on the weekly, we're somewhat neutral, even though the price is bullish. The CCI is giving us a warning signal, so just be wary. We might have a bit of a pullback. And if you're trading on the daily, we'll go in the direction of the weekly. So at the moment, you'd be not going long until you started seeing that CCI break above the moving average if you're trading on the daily. So the daily is actually probably showing a neutral to bearish momentum at the moment. You can see that you would have been going long from that period on the 1 hour time frame, according to this daily trend, and paying attention to the CCI pretty much moving sideways, giving us a somewhat of a bearish divergence. So you could argue that was a double top on the CCI, or slightly higher, compared to the steep price movement. So strictly not a divergence, but I'm going to call that a bearish divergence. You can see there it's pulled back, and that would have been your early warning signs whenever you see that pretty much a sideways move on the CCI. So you would have been going long during that period if you're trading on the 1 hour time frame, and you'd start going short from that period according to this daily chart. Again, closing it out whenever you see that CCI touch into that moving average range. Looking at the 1 hour time frame, what we're looking for is any divergence, and that CCI seems to be moving in tangent with that price. The last divergence we had was back here, going from that high, take to the same level as the price, to that level. It's lower highs on the CCI versus higher highs on the price. You can see there it pulled back quite strongly. And if we draw a Fibonacci from that high down to that significant low before the divergence started, you can see there it came right down to the 61% level and just below it, and pretty much moved sideways according to that. So that's broken below our 23-38% range, which is our minimum pullback on the 1 hour time frame. So there's no divergence at the moment to be concerned about. So if we go to the back test, remember we go in the direction of the daily if you're trading on the 1 hour time frame. So going back to the daily for a moment, I've got it starting from back here from the 26th of August approximately, when both the price and the CCI broke above the moving average band. Now this could have gone either way, by the way, just looking at this very consolidated period. The constriction, that's why I like using these moving averages. Whenever you see a constriction, it can go either way. It could go up or it could break to the downside, and that's why we also look at the CCI. That could have been a false break at that level, consolidated, and then it finally broke higher. So looking at the back test, you can see there from about that period in late August, going long, there would have been nice little trades to take. And remember, what we do is we look at the moving averages of the CCI and the price, and whenever you start seeing them break to the downside, you close out your positions. Going long, each of those little periods, closing it out. Going long, closing it out. going long, and so on, until you finally get to this point. As soon as you see those moving averages, you see there is almost a double top there on the price versus lower highs, you would have closed out your position at that point at the very latest, and you would have avoided that drawdown. Then started going long again during this little period and closing out again there. Maybe going long again there and closing it out again. Remember, the idea is not to catch a falling knife. We want to make sure we get out appropriately.
Don't catch a falling knife, man!
So looking at silver on the weekly, first off, the price is above the moving averages, and notice the CCI is broken into that moving average range, but also notice, very importantly, we've got this longer term bearish divergence, lower highs on the CCI versus higher highs on the price. I've marked a 23-38% retrace minimum, and it's already hit that with that candle there, but very likely we might see the price fall further according to the CCI dropping. That's why we also look at the smaller time frames. So if you're trading on the daily, I would not be trading until we see the weekly break higher. On the daily, it's a bit of an interesting situation here. Notice this seesawing effect. You would have been going long, ideally, from probably that candle there when the price and the CCI broke above the moving average range. The price was already above that range, and the CCI broke. Probably a bit of a false break there, but it continued. Watching that price movement, and you'd be closing it out. A couple of ways of doing it: letting it fall into that moving average range on the price, or if you're really conservative, getting out whenever that CCI touches that moving average range. So if you had you entered there, you would have gained those few points up until that candle there. Then re-enter again when the CCI breaks higher, the price is already higher, and closing it out again, maybe with a small loss, again depending on how risk averse you are, and going long again there. So there's a couple of ways of trading this, and that's the conservative way. Or if you want to trade on the 1 hour time period, you go in the direction of the daily, and that's why we look at the 1 hour period now. And you can see there it had a bit of a zigzagging effect. Again, noticing the divergence, bullish divergence, broke higher. Again, you would have been going predominantly short whenever, according to the daily, and going long, and these arrows here identify, oops, let me get rid of that. These arrows here identify the long and short positions according to the daily. So you would have started going long during this period, and then started, at the moment, not going short, because let's go back to the daily for a moment. You can see there, wait for the price to break below the moving averages to start going short. The CCI is already short, but you want to make sure you've got the right momentum on the price as well. Now, if we go to the back test, this is interesting here because I want to make sure you understand going long in direction of the daily, and you would have been going, again, according to our rules, when the moving averages are in an upswing, both the CCI and the price, and being cautious when the CCI starts dropping off, and then closing it out when the moving average of the price also starts to drop off as well. The CCI is giving you an early warning with that divergence, going long again there when both the CCI and price are in an upswing. Again, paying attention to the divergence here on the CCI, closing it out probably around that area, long, and so on. Here's very important to understand: the price starts to drop off, and that's why we always go in the direction of the higher time frame, and that would have avoided that drawdown.
Really?
So if you'd like to get some share trading ideas, these are some of the trades we've taken on our Patreon page. These are all closed trades we've taken, and they've returned 11.57% so far since the 21st of September. So to support the channel more, the Patreon page link is in the description below. Hit that like and subscribe button. Thanks for watching, and see you in our next update.